Welcome to the Savvy Ladies Wednesday Wisdom. My name is Lisa Ernst. I'm the Executive Director of Savvy Ladies. Before we get started, a reminder that we'll have a few minutes at the end of the presentation for your questions. Feel free to type your questions into the chat window. I'm so pleased to introduce you today to Iseult Conlin. Iseult is a bond trader for one of the largest buy-side asset management firms in the world and is responsible for U.S. dollar investment grade fixed income credit trading. She earned a BA degree in economics and psychology, magna cum laude from NYU. Thank you, Iseult, and welcome.
Thank you so much, Lisa, for the introduction, and sorry for the delay, having a little bit of technical issues. But again, thank you to Savvy Ladies for having me for this Wednesday Wisdom webinar series. Last week in our webinar, we talked about the basics of stocks and the stock market. This week, we're going to talk about the basics of bonds and the fixed income market. And I'm very excited to be talking about bonds because this is my expertise, and I think bonds are much more fascinating than stocks. I'm sorry for all the stock lovers out there. But the bond market is more than 2 times the size of the stock market. And the interesting thing is the price of a bond can be calculated pretty easily with a simple mathematical formula. Remember when we learned about valuing the price of a stock, it's much more of an art than a science. Well, bonds are fairly mathematical. You know, they make sense. It's pretty black and white. But there are so many different kinds of bonds, so it makes the bond market seem sort of intimidating. But remember what we talked about last week. Don't let Wall Street intimidate you. When we break it down into its component parts and really get the essence of what this thing is that we're investing in, we're able to make a understandable decision. So bonds are just another type of asset class. They fall under the category of fixed income, whereas, last week we learned about how stocks fall under the category of equities. So with that, let's get started here. And again, let's start from the beginning, that big thing called the economy. Remember, the economy is just a big global interconnected web of people, businesses, and money. So borrowing and lending, and by default, investing, is the only way the world is able to function. You can't get a car loan without a bank. You can't buy a home without a mortgage. You can't save for your children's education without investing somehow, whether it's in a 401k or something else. You can't buy groceries if the farmer in Kansas isn't growing grain. The farmer in Kansas can't grow grain unless he's able to buy seeds, and so on and so forth. The point being that we're very intricately interconnected. So, go ahead here. So when we talked about starting a business, we had 3, maybe 4 options for raising the necessary funds. We could, 1, borrow money from a bank. This is debt. We could, 2, borrow money from a friend. This is also debt, but maybe we don't have to pay back the interest because our friends are nice to us. Then we had 3, where we could borrow money from a bunch of people and offer them a stake in our company. That's equity. And finally, 4, we could just use our own money, but if you're like me, you probably don't have enough. I definitely don't have enough to start a business. But today, we're going to learn about 1 and 2, which is debt. A bond is debt. And many of you have probably read about when the U.S. government would go around during World War II asking you to buy government bonds to help fund the war. So you can see good old Uncle Sam here on the slide. He'd probably be really proud of all of us for listening to this webinar. But that's what we're going to talk about here. So, what is a bond? Remember my rule. You can't invest in something unless you truly understand what that thing really is. A bond is just an IOU by a company. An investor agrees to loan a company money, and a company issues them a bond. The investor is now called a bond holder, and the company is called an issuer. So bonds are simply a way for governments and companies to borrow money. Issuing a bond is usually less expensive than going to a bank and asking for a loan, and it offers the company or the government a little bit more flexibility in terms of their borrowing. So the thing is, no one's going to lend their hard-earned money for nothing. The issuer of the bond, the company, must pay the investor, the bondholder, something extra for being able to use their money for a specified period of time. So I made sort of a simple diagram here. You see there's a person on the left and the company is supposed to be on the right. So this is you, and here's the company giving you a bond. Pretty much that simple. So you all must be wondering, okay, so what's the difference between stocks and bonds? We talked about stocks last week. Now we're talking about bonds. They seem pretty similar, right? Well, as an investor, I'm still giving money to a company, but these two things are different. Stocks are equities, bonds are debt. As a stockholder, you own a stake in a company. You have a right to share in the future profits of that company because, remember, you literally own a proportionate share of all that stuff that that company is made up of, but you have no guarantee that you get any of your initial investment back. You hope that your stock appreciates in value, and you hope that the company has enough money left over at the end of the year that they decide to pay their stockholders a dividend, which, remember, is like interest, but none of this is guaranteed. And the only way for you to monetize your investment and get your money back is to be able to sell your stock in the open market for more than what you bought it for. So it can sound a little risky. Bonds, on the other hand, generally tend to be a safer investment. With bonds, you lend money and become a creditor to the company. So you don't have the right to share in any future profits, but the company does legally agree to pay you a coupon semi-annually or monthly in some cases, and they're legally obligated to pay back your entire investment at the end of the life of the bond. The only trouble here would be if the company goes bankrupt or something like that, but as a bondholder, you are first in line to be paid after the cost of bankruptcy. These would be legal costs, for example. So bonds are really similar to a loan, except that this time you are the lender and the company is the borrower. In my case, it's usually the other way around. I'm borrowing from a bank to pay for, say, my student loans or for a mortgage, and the bank is lending me money. But now we got to switch that around. And when you think of a loan, think about the defining characteristics of a loan. You probably have a stated interest rate that you pay every month. You have a total size or notional of that loan. How much did you borrow? And then you have a final maturity date of the loan or when you need to pay it all back by, and so on and so forth. Bonds also have these characteristics, but they have a lot more of them, so it can get sort of complicated. So let's take a look at some of these characteristics. So you have at the top an issuer, the person who actually issued this bond. This is just the company who borrowed money, or the government. You have a par value or face value, and you can think of this as the denomination of a bond. Most bonds have 1,000 denominations or higher, but sometimes in the case of government bonds, it can be 100,000 or higher. When a company issues a bond, they usually borrow a lot of money, and I'm talking $250 million or more in some cases. That would be deemed the amount outstanding or tranche size, as you see a little bit towards the bottom of this slide. You also have the principal amount, the amount you're willing to lend to a company, and the amount you should get back when the bond matures. Then you have the maturity date, the date in the future when the investor's principal will be repaid. You also have the coupon rate, which is important for people that really care about current income. That's the fixed percentage that is paid to the bondholder by the company, usually semi-annually, but as I said before, can be monthly too. And then you have bond credit ratings, which I will talk about in more depth in the next slide. And finally, you have yield to maturity, which you can think of as the percentage return on the bond if you were to hold it until maturity. So now, it kind of makes sense why bonds are considered fixed income. The income on the bond is fixed. You can literally map out every cash payment you're going to receive from this issuer based off of these defining characteristics of the bond. So just quickly, unlike stocks, bonds have a credit rating, and this is very important. You can think of this sort of as like the grades you got in school, A meaning higher quality, C meaning average, F meaning you're failing, even though in credit ratings we don't really have an F. Bond ratings are similar. They're given globally by sort of recognized rating agencies, of which 3 are the most well-known. That's S&P, Moody's, and Fitch. Credit ratings are used primarily to help investors in making investment decisions. So a credit rating is an evaluation of the credit worthiness of that issuer. We tend to lump different bonds into categories based on ratings. So for example, as Lisa said in the beginning, I trade bonds. I trade something called investment grade bonds, which are bonds with ratings above BBB-, and these tend to be the highest quality company. But then you also have governments of countries also have credit ratings, as you can see in this world map here. Green would be the highest quality, which you can see looks like Canada, the United States, Australia, as well as some countries in Western Europe. So I know the previous two slides had a ton of information on it, so I wanted to use a real-life example to help us understand the characteristics a little more. So my day job is as a bond trader, so I look at bonds all day long. And so I grabbed an actual bond that I trade regularly and pulled up the Bloomberg information page so we can see kind of what real traders and investors look at. So the issuer of this bond, you can see in the top left-hand corner, is General Electric. Everyone knows that very large company that makes everything from airplane engines to washing machines. You can also see on the top left-hand corner, this bond has a coupon of 3 3/8 or 3.375 and a maturity date of March 11, 2024. So General Electric is promising to pay you 3.375% annually on whatever you originally invested in this bond. And not only that, they're agreeing to pay you that for 10 years, so until 2024. You can also see on the right-hand side in the middle that this bond has ratings of AA3, AA+, which are high-quality ratings because it is a high-quality company from a credit standpoint. The amount outstanding on the bond is a little bit below that, $750 million, with one level below that, minimum denominations of 1,000. And you also have on the middle bottom the announcement date or the issue date of the bond. And finally, you have the yield to maturity, which is up on the top right-hand corner. And you can see that there's two yields because one is actually a bid, one is an ask. We're getting a little bit more complicated here, but this is for when you're trying to buy or sell the bond in the open market. So we don't want to go too complicated or too far into that. But once you guys can sort of understand that and understand what's on this sort of basic page, you can probably take my job. So now you've seen a bond, you understand what it is, but how does it really work? Bonds are all about cash flows. You make money from investing in stocks only if the stock appreciates in value. But owning a bond allows you to make money every 6 months practically. The issuer is legally obligated to pay you a coupon and your initial investment back. So for this reason, bonds are great assets for investors seeking safety and steady income. Think retirees. So we have a diagram here of the cash flows. You can see that every 6 months you are getting paid the coupon on this bond, which looks like it's 4%. So you may be saying, wait, why is it 4%, not 2%? It looks like it's $20 there. Well, you're getting $20 every 6 months. That adds up to $40 a year. The coupon is an annual figure, so that's why it's 4%. And at the end of the life of the bond, when it reaches its maturity date, you receive that last coupon payment as well as the initial principal you invested. So this is kind of the fun part, or at least the fun part for me, remembering how to determine the value of a stock. It's more than an art than a science. Bonds aren't that complicated to value. The price of a bond is simply the sum of all of these future cash flows discounted by an estimated discount rate. Now, the discount rate is the rate of interest prevailing in the market for bonds of similar risk and maturity. This is the concept of time value of money, which I don't go into too much depth here in these slides, but hopefully most people are familiar with the concept that money today is worth more in value than money in the future. So you ask yourself, well, why is that? It's because if I have $1 today, I can invest it and get back maybe $1.20 in a month. So it's worth more to me to have that money now than it is in the future. This is how we mathematically determine the price of a bond. We value all those future cash flows and we discount them back to today. So this is why it's a little bit more black and white and mathematical as opposed to a stock where it's kind of putting your finger up in the air and saying, well, I think this is what it's worth. So this leads us into the most important relationship you can understand in fixing some securities. Price and yield are inversely related. So to understand this, we really need to use an example. So if you buy a bond with a 10% coupon and it has a $1,000 par value, the yield is 10%, right? 100 over 1,000, 100 is 10%. Think of yield as the annual return if you hold it until maturity. So you pay $1,000, the company issues you a bond and promises to pay you 10% annually or 5% semi-annually. In 6 months, you receive $50, and in another 6 months, you receive another $50. So in total, you received $100 in coupon payments. So after a year, your $1,000 has just turned into $1,100. So you can think of your return as 10%. That was our yield. What happens now if the price goes down to $800? You're still getting paid that 10% coupon, which is $100 a year, but the price of your bond, your asset that you own, just went down. So the yield on the bond is now 100 over 800. That's 12.5%, right? Why does this happen? It's because you're getting guaranteed that $100 on the asset from your coupon payments, but now that asset is only worth $800. So if you look at it the other way, if the bond goes up in price to, say, $1,200, your yield is going to shrink to 8.33%. That is the most important relationship that you can understand in fixed income securities. So what affects the price of a bond? Well, interest rates in the economy, for one. Prevailing interest rates in the economy are what determine that discount rate that we talked about before. So there's an inverse relationship between interest rate and bond prices. As interest rates increase, that discount rate also increases. So when we discount those cash flows back to the present, we have a larger denominator. So the cash flows end up being worth less. So the price of that bond is also smaller. Inflation is also a big deal. It erodes the value of a bond because it erodes your purchasing power. Higher inflation usually coincides with higher interest rates in the economy, but not always. Then we talked about credit ratings. Those are extremely important. They tell you information about the creditworthiness of an issuer. Maturity is also key. The longer the maturity of a bond, the more likely it has a higher yield. Remember, that's our return. If I'm going to lend you money for, say, 30 years, I'm going to want a higher yield or annual return to lend you money for that long. Capital structure is also important in terms of priority claims and liquidity of the secondary market, which allows you to monetize your investment, but that's also getting a little bit more complicated, but I wanted to put those on the slide. And then I have a picture of the U.S. government yield curve. A U.S. government bond is called a treasury, and this is an actual yield curve as of November 10th, it looks like. It shows yield on the y-axis and time on the x-axis. You'll notice it's upward sloping, meaning as you get further out, say 10, 20, 30 years, the yield you are receiving by purchasing a longer maturity bond gets steadily higher. This tends to be a sign of a well-functioning economy. So then there are many types of bonds, and I think this is why the bond market can tend to intimidate people. We just talked about government bonds, but there are, other governments have names for bonds, like the UK government has gilts, the German government has boons. There's all these different names for government bonds. But then there's also municipal bonds. These are bonds issued by state and local government. So I'm from Massachusetts. My hometown in Massachusetts issues bonds. It's a way for them to collect funds outside of just tax receipts that they're collecting from their residents. Then we have corporate bonds. Those are issued by large public companies like IBM, Google, General Electric, as we saw previously. And then we have more complicated bonds. You can have bonds that are backed by a pool of assets. We call that ABS, asset-backed securities. The collateral that can back these are anything from cars, credit cards, home equity lines, equipment leases. As long as it has distinct cash flows, we can create a bond. And then different bonds have different features, like callability features. Can the company call this bond back early? Does the coupon float, i.e., does it not stay fixed? And there's many other features. So I just wanted to give you kind of a taste of the intricacies of bonds, but we won't get any more complicated probably than this. So finally, now that you understand what it is that you're investing in, how do we actually go about investing in bonds? We reviewed last week opening up a brokerage account, and once you have that open, you're able to invest in bonds. The bonds are generally considered safer than stocks, and for diversification purposes, my view is that bonds belong in every portfolio. Remember, the likelihood of your loss of your original principal is low, and you also receive income on a set schedule. The issue is, though, that investing in an individual bond, like that General Electric 2024 bond that we talked about in a previous slide, it tends to require minimum denominations of either $1,000 or, in some cases, $100,000. That's way too much for most people. It's way too much for me. So most investors use bond mutual funds and bond ETFs as a way to invest in bonds. And there are many options that you can take in terms of issuer and in terms of maturity. There are government funds, corporate funds, long duration bond funds, short duration bond funds. We didn't talk about duration here, but that's another way to sort of define what a bond is or the characteristics of a bond. There's funds for just high quality companies. There are funds for low quality companies. But I would say an optimal bond portfolio would be a mix of both government and corporate bonds of varying maturities. Remember, the bond market is 2 times the size of the stock market, so there's a lot of different options. And I actually put on this slide just a couple bond funds that have done well in the past and have high rankings, but do your research. There's many different funds that you can invest in. So with that, I'm sorry that I went a little bit over time and I was a little bit delayed, but bonds can be a very complicated subject, but remember, finance is understandable to anyone as long as you break it down into its component parts. So with that, thank you so much for listening to the webinar, and I hope everyone has a wonderful day.
Hi, Iseult. Thank you so much. And rest assured, I'm never coming after your job. That's a lot. That was great information, but it is complicated for sort of the average person to take all this in. So I actually wrote down several questions, and so I wanted to ask you, because we just recently had an election, and one of the issues for New York State was a bond issue for the schools. And so I know over time that happens a lot, like that you'll hear in the news like that there's a bond issue or they'll campaign for it. So if you vote for the bond issue, which in this case was millions of dollars so that the New York City school system could upgrade their technology infrastructure.
Mm-hmm.
Can you explain what that means and how anybody, what money transfer is happening there?
That's a really good question. So, if it's just for New York City schools, it doesn't necessarily mean that only investors or just Main Street people from New York City are investing in this. Anyone can really invest in it. But what it means is that New York City public schools are looking for a different source of funding, not from tax receipts or not from the federal government or even the state government or the city government for that matter. They're looking to private investors to fund a bond issue. So they issue a bond, and private investors or just people like you and me are able to invest in that, lend them money to be able to build this technology. And we are given a bond with a specific coupon and maturity, and that is our asset. That's something that we can trade. Now, it's a way for the schools to fund things in a different way, and they go to private investors to do that. I've seen that a lot. And the municipal bond funds that we talked about on this last slide, that would probably be where this bond falls into.
When I was asking you I was asking you about how you get your money back from a school bond.
Well, remember, so you lend them a certain amount of money. They agree to pay you a coupon. Most likely it's going to be semi-annually. And then at the maturity of that bond, they have to pay you back your original principal. So they actually are legally obligated to pay you back. So you should be able to recoup everything that you invested in.
Oh, okay.
As long as the New York City schools don't go bankrupt.
Yeah, well, the other thing I wanted you to go back and explain what Etfs are, because I happen to know it means electronically transferred funds, right?
Yes. Yep. So go ahead.
Could you just explain, what Etfs are?
Sure. So we talked about how you can invest in a single stock, and then we talked about how you can invest in a single bond. Mutual funds, mutual funds are what first started. They're just a big group of a bunch of stocks or a bunch of bonds. It's just many different line items in a fund, and they sell that as a package. The same thing with ETFs, except ETFs tend to have smaller fees and smaller taxes because of the way they're set up, but also the huge differentiation between mutual funds and ETFs are that ETFs can be traded intraday. You can trade it whenever the market is open. You're able to trade it. Mutual funds can only trade at the end of the day. So it gives you a little bit more flexibility with, how you want to trade it and when.
Right, and I understand that when you go to look for somebody to do your investments, if you're looking for somebody, that really should always be an option now, ETFs, right?
Yeah, I think so. They tend to have smaller fees and better tax structures. So I think ETFs as an opportunity for investment in your portfolio should always be discussed.
Okay, my next question is, so if General Electric is the example here, you can buy stock in General Electric, and then General Electric sells bonds, and then General Electric is making a profit off their the products that they sell and services they provide. Like, that's a lot of, how much money do they need?
It's a great question, and it's true. There's many different sources of funding. Not only do they issue stocks so that they can borrow money in the equity market, they issue bonds so they can borrow money in the fixed income market. But in addition to that, they also borrow money from banks. They have private deals where they go to specific investors and they borrow money that way. There's always need for capital expenditure, which is building new plants, hiring new people, buying new products, things like that. So they're constantly borrowing money. Every large company constantly is. They just have to manage it properly so that, with a debt instrument like a bond that we learned about, they have to be able to pay these people back at the maturity of the bond. So, they have to manage their cash flows very carefully.
Okay, well, thanks. It does seem like a lot of money. Okay, actually, here a question just came in. I understand there's something called a blue chip stock. Is there also something called a blue chip bond?
That is a great question. There isn't. When we talk about blue chip, we're referring to stocks, but that slide where we had credit ratings, that is actually the way that people tend to define bonds. They look at bonds from a ratings perspective, and that is how you look at what kind of issuer this is. So in that slide, let's see if I can go back. So in this slide with credit ratings, you can see that there's high-quality ratings, which are considered investment-grade companies. There's lower quality ratings, which are considered high-yield companies, and exactly what that word means is high yield because the yield or the return is going to be higher on that company. There's very speculative companies, and then there's companies that are in default or distressed. So that's how, when you say blue chip stock, that's a sort of a guide or a definition of what kind of company that is that you're investing in. We do the same thing with corporate bonds or government bonds for that matter. We just do it with credit ratings. So that's how you kind of define what company your bond is from, what type of company, what the credit quality is of that company.
Right. So that's something you should pay attention to is that bond rating.
Yes.
Now, how does a bond lose its value? Like when you said it goes down in price.
So that's a great question, and there's so many different factors that affect the price of the bond, and that was sort of in that slide where we talked about interest rates, inflation, maturity credit ratings. There's so many different factors that affect the bond price. If the company tomorrow announces that their earnings weren't good enough and they're going to have to raise a lot of cash because they don't have any money, that bond is going to sell off. Nothing may have changed in terms of the prevailing interest rates in the economy or prevailing inflation in the economy, but all of a sudden this credit or this company is not so credit worthy anymore, the price is probably going to fall. So in that slide where we said things that affect the price of a bond, all of those things and more can affect the price of the bond. And a bond trades just the same way that a stock does. It trades in a market, in a secondary market. Now stocks will trade on an electronic exchange, whereas bonds tend to trade over the counter. So in my day-to-day job, I'm mainly trading bonds over the phone. I'm actually calling someone and saying, hey, I need to sell or I need to buy this bond. So it tends to be a little bit slower. It can be a little bit more opaque than electronic trading, but they both trade in the market that same way.
Great. Well, thanks very much, Iseult. That has been, like I said, that's a lot of information, but it's great information just to understand the difference between stocks and bonds. So I really appreciate your helping us through that. I want to thank our attendees for some great questions, and be sure to visit Savvy Ladies to register for next week's webinar, which is the 3 C's of Embracing Your Inner Financial Rockstar with Barth. Thanks again, Iseult.
Thank you.